All right. Good afternoon, everybody. For those of you that don't know me, my name is Ryan Melliker. I am the president of Lodging Analytics Research and Consulting. And we're going to get started here on our June 2024 U.S. Outlook presentation. Thank you all for joining. Hopefully, some of you have been on our webinars before and you know kind of how this works. For those of you that haven't, hopefully you'll enjoy as we share some insights. It's been an interesting week with the NYU Hotel Investment Conference earlier this week. That was fraught with a lot of what I would call cautious to negative sentiment, which we think is kind of interesting because while we haven't been very positive for a while now, we see green shoots and improvement in our outlook going forward today that we didn't necessarily see 3 or 6 months ago. I'm going to get into that in a little bit. So there are some silver linings throughout this presentation that some of you might be able to, cling to a little bit, if you will. But before I get started, a few things that I want to highlight to everybody. Number one is the webinar is being recorded. We will have it posted to our website later today, hopefully, or certainly by tomorrow. So if you have to pop off at any point in time, you can always just log on to larkanalytics.com, LARC analytics.com. And we'll go ahead and you'll be able to watch the recording or jump on wherever you had to pop off. Second thing is, and we're going to get to ask this plenty of times, I know we are. Yes, the slide deck will be emailed out to everybody that is on the live webinar. So you don't need to ask for it. We're going to send it out shortly after the webinar is complete. The third thing that I'll make sure to highlight to everybody is that in your taskbar in Zoom, there's a little Q&A option. And you can certainly lob questions in. Katie Harding, one of my colleagues on the LARC team, is going to manage the Q&A process, and we'll make sure that there's plenty of time at the end of the webinar to answer any questions people have. If for any reason you either can't look at a question in or we're unable to answer it, or you just want to kind of discuss it offline, you feel free to email us. The easiest way to get a hold of us is information@larkanalytics.com. That's LARC analytics.com. And with that being said, we're going to go ahead and get started. Like I said before, for those of you that don't know me, my name is Ryan Melliker. I am president and co-founder of Lodging Analytics Research and Consulting, or what we like to refer to as LARC for short. Today's presentation, we're going to walk through real brief kind of the past few quarters of performance. We're going to really focus on kind of that economic outlook that drives our U.S. lodging outlook for both the top line and the bottom line. We're going to get into the market highlights, and then we're going to touch on one specific market and really drill into one of our tools, LARC GIS, which is an amazing web-based application that allows the user to really dig in super granular within a market. But with that being said, let's jump right in. So when we think about the U.S. industry review, whoops, too far. One of the things that we like to highlight is, hey, 2023 fundamentals on the headline metrics looked pretty good. RevPAR was up almost 5% on the year. However, it was very skewed to the first quarter, which we may all recall, right? Part of that was tied to the soft comps related to Omicron from the year earlier. What I think is important to note is as we look at the quarterly breakdown of supply, demand, occupancy, ADR, and RevPAR, one of the things you'll notice is that demand growth was negative in the second quarter of 2023, slightly negative in the third quarter of 2023, more negative in the fourth quarter of 2023, and then more negative in the first quarter of 2024. And obviously, occupancy gradually got worse as well. And obviously, in the first quarter, RevPAR was basically flat, up 0.2%, according to CoStar. So, as you think about kind of how the quarterly breakdown has been, there's really been now a full year of soft performance, if you will, which obviously is somewhat concerning, but there's two things that we'll highlight as positives. Number one is we're now through that full year, so comps are going to get less difficult, easier. And number two is this year's been kind of interesting where January and February performed exactly as we had expected going into the year. April and May have been pretty similar to what we expected going into the year. March has been the disparity. And why was March so soft? It's really hard to answer that question. I wish I had a better answer. I was talking to somebody else at the NYU conference, and his response I thought was funny. He's like, I don't know, because Easter was on a Sunday. I'm like, Easter's always on a Sunday. That's not very helpful. I think the best answer I can give you as to why March really disappointed, and obviously there was an Easter calendar shift, but we had built that into our expectations. What was interesting was the Easter calendar shift in March was more negative than it normally is. The Easter calendar shift in April was more similar to what it normally is, which net led to some net negativity between the two. Which is a little, trying to understand that. I don't have a great answer. The only thing I can set, the only thing I can speculate on is maybe in March of 2023, Easter strength was just much more meaningful because it was more tied to spring break weeks, and had a bigger impact in terms of compression demand and compression pricing than we necessarily, creating a slightly greater, more difficult comp than we might have expected or might have normally realized with that Easter calendar shift. Just something that we're trying to figure out. Don't have a great answer on it, but I want to highlight that to everybody, because I think at the end of the day, when we look at our outlook for 2024, outside of March, nothing's really changed. Our forecast over the last 3 quarters of the year is the same as it was before. It moved from 2.5% RevPAR growth to 2.4% RevPAR growth. If anything, we're getting incrementally more positive, especially as we move beyond 2024, where we've now had 3 straight quarters where we revised our 2025 RevPAR up. So from our perspective, I know that at the NYU conference, and there's a ton of headlines surrounding everybody slashing their RevPAR growth estimates. Our view is people are coming closer to where we were for 2024, and we're getting more aggressive for 2025, which is kind of encouraging, if you ask me. Nonetheless, the sentiment and the tone at NYU seemed relatively somber, in my opinion. That being said, as we move beyond the national metrics, as we all know, this is a market by market, street corner by street corner business, and the national metrics are great to an extent, but understanding which markets are going to outperform and which markets are going to underperform is incredibly important, because there can be a vast disparity from one market to another. And 2023 is a great example where you had markets like Las Vegas, Washington, New York that were up almost 20% each. And then you had markets like Florida Keys, Santa Barbara, New Orleans, Miami that were down massively, right? So, those 25, 30% swings are huge and have obviously a huge impact, not just on the top line, but on the bottom line. And understanding those dynamics and understanding those things is really important. So national metrics are healthy and helpful to understand, but I wouldn't make any investment based on national forecast for RevPAR. You really need to understand what's going on in your market and really your street corner, and we can help if interested. Moving beyond top line across the country, as we talked about, RevPAR growth was great in 2023, up 4.9%. Hotel EBITDA was up 7.8 as a result of that, just strong EBITDA growth, but we estimate values actually moderated slightly. Driven by, or not moderated, but weren't really as strong as that EBITDA growth because of rising cap rates, and the outlook for cash flows moderated going forward. And obviously values aren't just based on an in-place cash flow and a cap rate. Anybody that values hotels based on a single year's cash flow and a cap rate is probably making bad investments. Hotels generally are valued based on long-term discounted cash flow models because of the volatility of cash flows. 1 year's cash flow is not indicative of the next 5 or 10 years of cash flow. Hopefully we all understand that. And that's certainly how we value hotels and how we look at markets. Okay, moving beyond 2020, 2023 and 1Q 2024, let's talk about the factors that are going to impact the rest of 2024 and 2025. One of the things I think we do is we really look at the different demand segments and try to find the themes that are spreading across the different demand segments to give us confidence or caution surrounding the growth that gets built into those demand segments and our outlook for the nation as a whole. And then once you have a view on the demand segments, you can start to look at individual markets and understand what the mix breakdown is and the challenges or opportunities between the market and the sub-market and individual assets, which is how we like to operate. So with that being said, let's start with office. So here's a few headlines, right? These are all super positive headlines talking about the return to office, right? from major news sources, CBS News, Fox Business, Associated Press, all within the past 3 weeks or so. Guess what? This is nothing new. We've seen headlines like this for the past 18 months. And while they are encouraging, they have not necessarily translated into an increase in office utilization. If you look at Castle Systems data, which we think is pretty good data, not perfect, don't get me wrong, but the way we like to look at Castle Systems is rather than looking at their absolute office utilization level, which we think is skewed to the types of assets that they've got data on, we tend to focus a little bit more on how is it moving and is it changing or not changing. And the reality is, for almost 18 months now, the national index has been relatively stable at around 50% of 2019 levels. That's a big, that stability kind of points to, hey, we've had all these positive headlines and all these things are happening, yet none of it's actually impacting the utilization metrics. Not more people aren't going to the office just because we see these headlines and all these announcements. It hasn't materialized. We're not confident you're going to continue to see you're going to see any inflection points for office utilization. Do we think things will gradually improve? Yeah, gradually, super gradually. Companies that are in the office 0 days a week may go to 1. Companies that are in the office 2 may go to 3. Somebody's 3 may go to 4, etc. But the idea of companies going back to that 5-day a week from a 0 or a 1 or a 2, I think is very, very unlikely, is our view. And as a result, you're not going to see corporate transient demand see an inflection point where things just start to skyrocket. And that's built into all of our assumptions and our analyses. Now, that being said, that doesn't mean corporate transient demand doesn't have upside. We think it has a tremendous amount of upside. And to give you some perspective, corporate profits this year are expected to be up 5% after being down last year. That's encouraging. In fact, corporate profits are still expected to be 30% above 2019 levels this year. Stock market, already up 10% year to date, was up 24% last year, and it's 62% above 2019 levels. Now, why do I talk about 2019 levels for corporate profits and the S&P 500? Because these are two primary metrics that help drive corporate transient demand. And they are well above 2019 levels. But corporate transient demand is well below 2019 levels, as we all know. The difference there being that office utilization component. Bottom line is, there is upside as we continue to see office utilization gradually tick up. There is ample opportunity for corporate transient demand to expand, and it's not an issue related to corporate balance sheets or profitability or stock prices. It is all about whether it is useful for those companies to get on the road and travel. And that one of the factors that's going to drive that is if there are people in the office for them to go see. The other thing that we'll highlight is that when the stock market's at an all-time high, companies are trading at premium multiples. When companies are trading at premium multiples, they have to justify earnings growth. They have to generate revenues. Generating revenues, they've got to go on the road and travel to meet with clients and prospects. So all of that points to positivity surrounding growth in corporate transient, which gives us some optimism over the next couple of years. That being said, it is measured by the fact that office utilization remains muted, and we don't see a big change in that in that mentality going forward. Moving beyond corporate transient, let's talk about group. We tracked the 30 largest convention centers across the U.S., aggregated the data here in this chart. And what you can see basically is that this year, convention booking pace is up 4% from 2023. Nice positive tailwind. 2023 was really strong, up 14% from 2022. That's encouraging. It's good for 2024. 2025 is pacing down slightly, down 3% year over year. We think that will likely end up being a modest headwind when we end up hitting 2025. And why is that down? Well, one of the biggest answers I have is the presidential election year. When there's a presidential election year, companies are a little bit more reticent to book things further out. Could some of that fill in the back half of 2025? Absolutely, but it's just something to keep in mind that may be more of a headwind next year than it is this year. But of course, 4 up 4 down 3. Those are generalizations across the country. There is wide disparity. Seattle's the strongest market in the country this year, up 37%. DC up 25%. San Jose and Charlotte both up around 20%. Meanwhile, San Francisco down 31, Boston down 15, Tampa and Austin down close to 10%. So you look at some of those metrics and you can get a sense of, hey, these are markets that are positioned to outperform or underperform, at least from a group perspective, which can be helpful. Now, moving beyond convention, let's talk about the leisure segment. And the leisure segment is fraught with what we would refer to as an unhealthy U.S. consumer. Those of you that were at the NYU Hotel Conference heard a lot about this. When you think about the NYU Hotel Conference, the economists came out talking about the health of the consumer. With all the forecasts that were presented, there was a lot of concern surrounding the U.S. consumer. This has been something we've been talking about for a few months now, that we were worried about an unhealthy U.S. consumer creeping in. Well, it's definitely here now. April retail sales growth, 0%. April Visa spending index dropped 5%. The April Visa discretionary spending index dropped 4%. These are now at the lowest levels they've been in quite some time, and the second lowest level outside of the pandemic in the past 10 years. Okay, so the U.S. consumer spending is pulling back pretty meaningfully. Meanwhile, headline inflation is picking up. So if inflation is going up and they're spending less, what does that mean on actual travel and other discretionary spends? It's likely to be going down. Moving on to the challenge that unhealthy U.S. consumer may be here for a little while is some interesting data from Deloitte. They issue a U.S. consumer spending intentions index, and the May spending intentions index is second lowest level since January 22. The savings and investing index has ticked up, and importantly, and I'll tell you why that matters in a second, and importantly, the leisure travel intentions index was now negative for the third straight month below zero. Why is that a concern? Well, we're heading into the summer leisure travel season, and the last 3 months have seen a decline in intentions on spending for leisure travel. That doesn't bode well for the summer leisure travel season, which we think will be a little challenging for those hotels catering to domestic-oriented leisure travelers. That being said, there is a little bit of upside. But before I get to that upside, I want to just highlight, why does that personal savings rate matter that I just mentioned as continuing to tick up? There's actually a negative 86% correlation between the U.S. personal savings rate and the share of the consumer's wallet allocated to food service and accommodations. Basically, when the U.S. consumer is saving more, they're spending less on big ticket items like leisure travel. When they're saving less, they're spending more. Well, obviously during the pandemic, savings spiked because of they couldn't travel and do anything, and that led to massive, and they also got fiscal stimulus, and that led to a massive, pent up leisure demand and an ability to spend money on that leisure, and leisure just cranked in 21 and 22, right? Well, now and then since then it has come back down, right? Now we're starting to grow again, right? And as we grow, as you see that savings rate pick back up, what that basically means is that we are likely to be spending less on accommodations for the U.S. traveler, or U.S. domestic leisure traveler. But like I said, there is a silver lining, and that silver lining is tied to foreign inbound. So in 2023, foreign inbound traveler volumes were 16% below 2019 levels. Through year-to-date April, they're up year over year 15% and just 9% below 2019 levels. There's a lot of positive momentum. I wouldn't read into that April noise. That's part of that Easter shift. But net, we're feeling really good through April. Year-to-date numbers look really strong. Seems like there's a lot of positive momentum as we're generally trending in the right direction. Unfortunately, international outbound has the exact opposite going on, in that travel volumes were up 11% versus 2019 last year. And year to date, they're up another 11% year over year for a total of 20% above 2019 levels. The reality is, we talk about the health of the U.S. consumer. That's a broad statement about the broader U.S. consumer. The affluent consumer that has the means to travel abroad is opting to do so. And one of the reasons why they're opting to do so is the dollar is very high. foreign travel, foreign locations are effectively on sale. And that is translating into foreign, US citizens choosing to travel abroad much more than they're choosing to stay domestically for some of their leisure trips. Those that have the means are choosing to. So the affluency is having that impact today, likely throughout this summer. Now, will that change? We hope so, and we'll talk about that right here. So, the falling US dollar will be a tailwind. The question more is when, not if. For those of you that have been on this webinar before, this is something we've talked about. And if you go back and you look at this chart from a quarter or two ago, the chart looked more like this. Ooh, right? Unfortunately, what's happening is the dollar hasn't fallen as fast as we thought it would going into the year. The dollar's been much more resilient than most economists expected. And as a result, you're actually seeing the dollar, increase a little bit through the second quarter of this year before the decline starts again. Now, the decline is good, as I mentioned. When the dollar decreases, U.S. destinations become more affordable for foreign inbound travelers, and international destinations become more expensive for U.S. travelers. And that means there's more domestic and foreign travelers for U.S. hotels. The challenge is that is probably looking to be more of a tailwind for 2025 today than a 2024, because there is a lead time component to this. Nobody says, hey, the dollar is going to fall in 6 months. Let me book my trip to Greece in 6 months. Or vice versa. Let me book my trip to the U.S. in 6 months because the dollar is going to fall. That's not how we think. It's usually after it has already fallen. Oh, look, the dollar's gone up. I can go travel abroad because that 5-star hotel in Paris is really affordable, or that 5-star hotel in Abu Dhabi is really affordable. You get the idea. Whereas the flip side, when the dollar is weakening, same dynamic, but there is a lead time component to this. This is looking to shape up to be more of a 2025 story than a 2024 story, unfortunately. Just something to keep in mind. Now, we talk about the strength of inbound international, not equal across every market. As we all know, there are some markets that have a lot more exposure to inbound international than other markets. Miami's kind of an interesting one where we'll highlight Miami's got a ton of inbound international demand, but it's a lot of Latin American demand that's where the currencies are pegged to the US dollar. So you actually don't get the tailwinds from a falling dollar from those currencies in those countries as you do from a Europe or Asia. Just something to keep in mind with Miami there. But you can obviously get a sense of which markets have the most exposure versus which ones have the least exposure. But just because they have a lot of exposure doesn't mean they have the most upside. What's kind of interesting is if you look at where each market was relative to 2019 last year, you'll see there's markets like Honolulu, which has a ton of Japanese exposure. Still, international demand was still 50% below 2019 levels. Massive, massive number, tons of upside in terms of recovery across the Hawaiian markets as a result. Meanwhile, a market like DC was back to 2019 levels. Why was DC back to 2019 levels? Well, DC's inbound international travelers tend to be tied to dignitaries, foreign politicians, et cetera. And that demand is relatively price inelastic. It's not about, don't get ahead, and it comes in year in and year out, no matter what, because it's tied to government. So stable, steady Eddie, you don't have those challenges. You don't have as much upside as a result coming into DC going forward from foreign inbound travel, but you certainly don't have the downside either when things slow or turn. Moving beyond foreign inbound international, another thing that we'd love to highlight is I'd be remiss if we didn't mention, hey, we all know, this is a presidential election year. Well, what does that mean? Well, in the past 4 presidential election years, demand growth and RevPAR growth have both decelerated from the prior year. In 5 of the past 6, business investment decelerated, and 4 of the past 6, GDP growth decelerated. So at the end of the day, these are just data points. We believe that, as politics in the US has gotten increasingly polarizing, not talking about which side or any of that, the reality is politics have gotten more polarizing. There are companies that look at one candidate as saying being better for them, and other companies that say the other candidate is better for them. And if they don't have confidence in which one is going to win, they take a wait and see approach before they want to try to embark on investment growth strategies, things like that. And that obviously is the same impact on the consumer. So keeping all of that in mind, there's a little bit of a wait and see approach over the next few months that is likely to play out, especially as the media takes a keen focus on the presidential election, and as well as the Senate and the House elections. So just something to keep in mind that creates a little bit of a headwind for this year. The good news is it's a tailwind for 2025. So it gives us, headwinds and tailwinds. Again, 2025 starting to get incrementally better and better every time we revisit. Moving beyond that, when we look at our U.S. economic outlook, a couple of things I'll highlight. GDP growth. A couple quarters ago, we had GDP growth materially slowing from Moody's in 2024. Now it's on par with where it was in 2023. So positive revisions upward from the economy. This is encouraging, certainly encouraging as we look out beyond 2024. Job growth still expected to slow, but remain positive. Unemployment rate tick up, but not dramatically. CPI growth moderating. That's obviously good. Corporate profits going from negative last year to positive this year, as we talked about. Even consumer confidence is expected to turn a corner later this year, which is pretty encouraging. The dollar, again, is a late 2024 story more than it was an early 2024 story like we had hoped. And then 10-year Treasury yield from year-end 2023 to year-end 2024 is expected to moderate ever so slightly, maybe 20 basis points. So not a big number. But net, that gives you a sense of kind of where the major factors are forecasted for 2024 on a quarterly basis. And then some of our key assumptions, the Fed. Everybody always asks about the Fed. The Fed, we expect a cut late this year, followed by 25 basis points per quarter through 2027. That is a Moody's assumption that goes into our models. Inflation will moderate, no near-term U.S. recession, over the next couple of years, but growth is not exactly gangbusters either. All right, so that frames the backdrop for the hotel forecast that I know you guys all want to hear and want to discuss. So let's jump in. Let's talk about top line first. So top line, everything that we just talked about kind of goes into that demand segment outlook. From a demand segment perspective, we look at corporate transient demand and say, hey, corporate transient demand is likely to stabilize this year around 10% below 2019 levels. Continued upside this year. We're not suggesting there's not. It's encouraging. It's great, but we don't think it will ever get back, we don't expect it anytime soon to get back to pre-pandemic levels. Group, on the other hand, is very strong, because at the end of the day, if people aren't in the office as much as they were before, companies are getting people together more frequently. As they get people together more frequently, whether that be in-house meetings, corporate retreats, or they just bring more members of their teams to different conferences so the team can be together more frequently, that all leads to more group demand. And we estimate group will continue to gradually tick up and stabilize around 10% above 2019 levels. Meanwhile, then there's leisure, the 800-pound gorilla, right? Leisure, we estimate in 2021 was about 65% above 2019 levels. Huge number, right? Really, really strong. It then moderated substantially, but was still really strong in 2022, up over 40% above 2019 levels. Then 2023 started to moderate. We think it will stabilize this year. This is kind of okay. Whatever fall that we're experiencing for domestic leisure, it's going to stabilize this year, and that's really encouraging. And then things will start to improve modestly thereafter. We'll be at around 15% above 2019 levels. So if you look at the demand segments relative to the pre-pandemic, leisure is the clear winner, followed by group, and corporate is the clear loser. If you look at things relative to 2023, group looks more like the clear winner, followed by corporate transient, while leisure is the clear loser. So again, what your baseline is really matters. We think 2023, there was just a little too much heat in leisure. As that normalizes this year, and we look at this year as a year of normalization for those metrics, we're going to see some positive growth going forward. And leisure is not something that we dislike long-term. We love it long-term. There's just some noise this year related to that. Supply. We get a lot of questions on supply all the time. Bottom line here is we think supply growth is really benign. Our outlook for supply growth is less than 0.5% of the supply growth this year, followed by about a little over 1% next year. But net over the next 5 years, supply growth is going to stay around 1%. So a very muted metric. Long run average is close to 2% across the U.S. So this is half of what we've seen historically from a percentage basis, and that's encouraging. Generally speaking, there are not a lot of markets where supply is the big red flag for us, where we're saying, oh, supply is the reason why we're cautious on that market. Now, there are sub-markets where we have some concerns surrounding supply. Atlanta CBD is a great example of one of those. But generally speaking, we don't have a lot of concern across broader markets. We're just not seeing the supply growth on a broad-based dynamic across the country or even any one market that gives us pause to say, hey, this is a reason to really not like this market right now. There might be other reasons not like the market, but supply generally is not one of them, with the exception of some sub-markets that have some unique situations going on. Now, when we look at our RevPAR model, this is our actual model that I'm sharing with you. The dark blue line that you see here is RevPAR as reported by CoStar on a seasonally adjusted basis, going back to 2000. What we've done is we've tried to predict that RevPAR using all kinds of other macroeconomic factors. And what this is a back testing of our model prediction, which is based on these core focal points: unemployment rate, GDP, profits, foreign exchange rate, personal savings, consumer confidence, all those factors. And then based on Moody's Analytics forecast for those factors going forward, you can see where the outlook for a RevPAR is going forward. Our model historically has a 98.7% R squared. Highly accurate model. Historically, for those of you that don't remember your stats class from college, that basically means it has 98.7% of all the variability of RevPAR across the US. My question to you is, if you're looking at other forecasters out there and I encourage you to ask them for this data about their models. And when they won't share it with you, I think there's a great challenge there. Transparency in forecasting is incredibly important. We all know no forecast is going to be perfect, but understanding the process and what gives you confidence is always important. That's what we share with our clients. We think that matters. So here you actually see what goes into our RevPAR model. Same thing with ADR right here. Dark blue line actuals on a seasonally adjusted basis from CoStar. Light blue line, that model that we've built, 98.8% R squared. Drivers are a little bit different over here, but again, highly accurate model historically, giving us confidence that our forecasts are accurate. And then when you look at the actual forecast, our outlook for 2024 is up here, and you can see how we stack up to all the other major forecasters out there. We are the most cautious in terms of occupancy, not just this year, but really going forward. Our concerns surrounding corporate transient demand are weighing on absolute occupancy levels for really the entire cycle, which has our numbers a little bit lower than everybody else's. Again, everybody else has kind of come down to that 2% RevPAR level, which is kind of where we think things should have been before. So we're all kind of in that same ballpark, except for CoStar. That reality is CoStar probably just hasn't been updated for STR's revised forecast earlier this year. That January should actually say June. That's a mistake on our end. That was just updated on Monday. So net RevPAR growth is pretty similar across the board. We are the most cautious on occupancy. We are also the most positive on ADR growth at $160, which gives us some encouragement. Again, we think ADR is where you want to be pushing things, not occupancy, for obvious reasons, because it flows to the bottom line a little bit better. For 2025, we're kind of middle of the road at about 2.1% RevPAR growth, which, keep in mind, is a bit of an acceleration from 2024. So again, 2 or 3 quarters ago, we actually had negative RevPAR growth built into our 2025 outlook. Today, we now have accelerating RevPAR growth. So things are definitely improving in that front and giving us some optimism and some hope for next year, which we think is pretty exciting. But again, our forecasts really are middle of the road. You've got some forecasts that are closer to 4%, and then you've got PwC, who's below 1%. And then moving on to the quarterly forecast, a couple of things that we'll highlight about the quarters is, number one, 1Q, we believe, is the worst quarter of the year. We talked about it earlier. January and February were in line with our expectations. March really disappointed. And then 2Q, April and May, have largely been aligned with what we were looking for. Hopefully June will be as well, and 2Q will be the best quarter of the year. And then 3Q, and keep in mind, 1Q had a headwind from a calendar shift, 2Q had a tailwind from a calendar shift. 3Q and 4Q, the Jewish holidays are moving. And as the Jewish holidays move from September to October this year, 3Q gets a tailwind and 4Q gets a headwind because you don't get a lot of conferences and conventions surrounding the Jewish high holidays, which will now be in October. All of them, Rosh Hashanah, Yom Kippur, Simchat Torah, all of them. So that has a big impact on October numbers, and it's going to be a tailwind for September. So despite the fact that we have a pretty cautious view on domestic leisure demand, we actually have decent RevPAR growth in the third quarter, largely tied to that tailwind from softer comps in September. But then that reverses in the fourth quarter with a more challenging one. And then for 2025, all those reverse back, which makes things more interesting. So strength in the first quarter of 2025, followed by weakness in the second quarter, et cetera. But as you think about that quarterly review, those calendar shifts have a big impact, and we pay attention to that pretty closely. Now, when you look at the different price classes for 2024, which is the light blue color here, you'll see we believe it's really just comes down to that segment shift that we talked about, right? Group is going to be strong, corporate transit is going to be strong, domestic leisure is going to be weak, foreign inbound leisure is going to be good, right? Well, that points to upper upscale and luxury, which benefit from group, corporate transient, and foreign inbound leisure will be the outperformers. Meanwhile, upscale and upper mid-scale, which is a little bit more corporate transient, will be okay. And then the segments much more focused on domestic leisure are going to be the underperformers this year. And that's how that will shake out, in our view. Now, if you look at those forecasts relative to 2019, clearly luxury has been the clear winner, and we expect that to continue to be the case. And then all the middle segments, upper upscale through mid-scale, are really very similar, ranging from 10 to 13% above 2019 levels this year. Economy continues to pull back a little bit, which again, it has been pulling back the last couple of years, and that's weighing on that performance. Now, why should you trust us beyond what I showed you in terms of our modeling and our transparency? Well, better data in equals better data out, right? We use only the best data providers. We're very transparent about if there's somebody that's got better data for us to use, we want to use it. We want to build our models to be as robust and detailed as we possibly can. And that doesn't mean skimping on data. That leads to high price data in most cases, but we believe we use the best data providers across the industry. And I don't think anybody else will, pulls together the data that we pull together. I also think it's amazing that I'm pretty sure we're the only forecaster that actually gets convention pacing data from the local CVBs, which we think is really important in a lot of markets. But that's our view. Fortunately, it has also showed up in actual results. In 2021, across the country, we were the most accurate forecaster for occupancy, ADR, and RevPAR for the forecast in December going into the year. Not December coming out of the year, December 2024, 2021. Same thing in 2022. Excuse me. Interestingly, in 2022, what we'll highlight here is that we were $6 above anybody else for ADR. And we still warned our clients that we thought our ADR metrics were too light because we didn't think our models accurately accounted for the impact that elevated inflation was going to have, because we had never seen that type of inflation for any period that we had ADR data. As a result, we said we'd take the over on our metrics, even though we were $6 above anybody else, and that's exactly what happened. Nonetheless, we were still the most accurate for occupancy, ADR, and RevPAR. For 2023, we were not the most accurate. It happens, I know. We give PwC credit for having a great forecast for 2023, where they were spot on ADR and super close on occupancy and RevPAR. Unfortunately for us, only us and PwC were within 1% of both occupancy and ADR growth. Everybody else that may have been close on RevPAR, it was because they were wildly off in opposite directions, and it netted out as being close. We feel pretty good about that outcome, but again, we want to be more accurate. So hopefully we are this year. We feel pretty confident that we are. And then at the market level, of the 62 cities that we issue quarterly forecasts for, In 2022, our forecasts were more accurate than the leading provider 70% of the time, by a factor of almost 2 times. And in 2023, that was also about 70% of the markets by about 90 basis points. On average, that 90 basis points would have jumped to 125 basis points if we exclude San Jose. San Jose is a huge component. We really missed San Jose in 2023. Why? Because of the Silicon Valley Bank failure, which had major impact on the San Jose Silicon Valley market, everything from in venture capital and tech and corporate transient demand that was expected to recover did not. As a result, for at least 6 additional months, that was not expected going into the year. So we got that wrong, obviously, but at least we know why. Otherwise, we would have been that much more accurate than everybody else. Okay, moving on to beyond the top line, let's talk about profit and values. We look at lodging expenses. Bottom line, wages, the worst of the wages is behind us now. Wage growth is starting to normalize. We've got Moody's has a 3.2% CAGR for hotel industry wage growth over the next 5 years. It's relatively stable year over year. Now, that being said, there are massive changes based on your market. Los Angeles just had a union labor contract negotiation. San Francisco and New York have them coming. There are markets that have massive elevated wage growth that do not align with that 3.2% level. That is a national metric. There are some markets that are way above that, others that are below it. So just something to keep in mind. Property taxes up 4.2%. Insurance expense growth will remain elevated, but it's going to continue, to moderate. Growth will moderate. And then other expenses we have growing at inflation. We assume historical levels of cost flexing across the industry. And that net leads to expense growth on average across the US around 2.5% annually over the next few years. Again, keep in mind we have negative occupancy growth. So negative occupancy translates into you spend less on cleaning rooms if and checking guests in, all those things if you have fewer occupied rooms. And that translates into hotel EBITDA growth that's modestly positive this year and next year, negative in 2026, before modestly positive in 2027 and 2028. Net for over the next 5 years, we expect positive cash flow growth. That's encouraging, right? Now moving on to cap rates and values. Just like our ADR and RevPAR models, here's our cap rate model on 98.5% R squared. Dark blue line is actual cap rates as provided by CoStar. Light blue line is the model that we use to forecast cap rates going forward. You can see the factors that drive it. Feel pretty confident about our outlook, which basically points to slight gradual increase, very slight over the next few quarters and few years. And the way we look at valuation is we do not believe that hotel values should be generated based on a single year's cash flow and a cap rate applied to that single year. I'm not sure any institutional investor does believe that's the case. But cap rates are important because they help drive discount rates, which are impactful to valuation using a discounted cash flow model, which is exactly what we do with cash flows looking out 5 to 10 years. So cap rates matter, but our values move based on the change in discount rate and change in cash flow outlook over the next few years. So as we look at our 2024 metrics here, one of the things that you'll see is hotel EBITDA is only expected to increase less than 1%, but we have hotel values increasing 4%. Why? Because we're getting more positive on cash flow growth than we were before, right? That's a positive. That leads to stronger growth. Overall, we've got, as we highlighted before, ADR up 2.6, occupancy down 0.8, RevPAR 1.8. When we look at moving forward on a 3-year CAGR and a 5-year CAGR, essentially, this is the worst year for occupancy declines. Things will gradually stabilize, if you will, in the coming years. ADR growth, however, will slow over the next couple of years. And then RevPAR growth will be pretty consistent as we look at 3 years and look at 5 years. Hotel EBITDA growth will then be negative over the next couple of years because of that 1 year that we highlighted was negative, followed by slight growth, similar to what we're seeing this year over a 5-year period. And net value growth will decelerate from this year through the next few years. When you look at our forecast change from last quarter, what you'll notice is that we were slightly negative, slightly down in revisions for everything. Again, really, really tied to those March metrics. You back out those March metrics, and everything has been relatively consistent with our expectations. Now, looking at values from a longer term perspective, what we'll highlight here is that, if you look at values during this cycle, they fell faster than we saw during the Great Financial Crisis, recovered faster than we saw during the Great Financial Crisis. And here's where we are right now, and the challenge that you have right now is that following the Great Financial Crisis, we continue to see robust growth in values, and value appreciation being really, really strong. And we're not forecasting that. What's the difference? The real difference is interest rate environment, right? We're not in a 2%, we're not in a 2% treasury yield environment anymore. And we don't think we're going to be anytime soon. So as cost of debt is materially higher, it impacts M&A and impacts valuations. And we generally just don't see the value appreciation in the later stages of this cycle, like there was following the Great Financial Crisis. Now let's talk about the markets. But so this is the 62 markets that we issue quarterly forecasts for. We do these every quarter like clockwork. If you're interested in purchasing any, let me know. We sell these on an ad hoc basis or on a subscription for a given market or for multiple markets. The more somebody buys, the more somebody saves, right? Anyway, regardless. National performance is largely aligned to economic growth. You hear this time in and time out, and there's nothing new. It shouldn't surprise you. The reality is GDP has incredibly high correlation with national demand and national RevPAR. It has over the last 20 years. And during the pandemic, those relationships only were enhanced because we didn't have much foreign inbound travel, and we didn't have a ton of foreign U.S. outbound travel. So everything was U.S. centric, right? Demand and performance were all tied together because people didn't travel outside of the country. That's why those metrics were higher 2019 to 2023. When you look at things on a market level, what you actually see is much, much lower metrics, right? The R squared is much lower, from 2000 to 2019 for STR's top 25 markets, correlation much lower. And from 2019 to 2023, the correlation is only 3.0% and R squared is 0.1. So the relationship is totally broken down. Why? Because when you look at a lot of leisure-oriented markets, and I use leisure as an example, you can pick on the Florida Keys. Local economic growth doesn't drive demand to the Florida Keys, right? It doesn't matter what Florida Keys GDP is, or Monroe County GDP is. That's not what's driving demand because it's a pure leisure destination. So what are the feeder markets and what are the macro factors that drive people to want to travel to places like the Florida Keys are what matter. If you try to build out a model based on local economic activity or local job growth, those are effectively outputs of the tourism industry, not inputs to it. So that's the type of thing that we look at to try to better understand what drives individual markets and how are they differentiated. Here's our RevPAR outlook for the 62 markets we track on a quarterly basis for 2024. One of the things that you'll notice when you think about the markets that are poised to have the strongest growth this year is they have outsized exposure to Asian international demand, corporate transient demand, strong group booking paces. They also tend to be markets that have recovered some of the least to date. Markets like San Jose, Philadelphia, Seattle, Honolulu, Minneapolis, Portland fall into that camp. And meanwhile, the bottom performers, those are markets that are predominantly catering to domestic leisure demand, or they have soft group bookings. Kauai may be the biggest exception to that. And that's just because Kauai benefited tremendously in 2023, tied to the Maui wildfires, where a lot of tourists relocated their trips from Maui to Kauai. That's a headwind for 2024. It's not a long-term issue, just something to keep in mind when you look at Kauai metrics. 5-year RevPAR forecast for these 62 markets. Our top markets tend to either have soft comparisons from 2023, think Maui and the wildfires, Portland, Raleigh, Honolulu, or they're strong markets undergoing major, we'll call it structural shifts across the market. Las Vegas, Puerto Rico, and Palm Beach fall into that category. Other markets with outsized leisure exposure but strong macroeconomic trends are also really positive from a long-term perspective. Sedona, Mobile are two of those markets. Now, keep in mind, that doesn't mean to say they're great for 2024, but long-term, we like those markets. Bottom performers tend to lack international travel demand. They have sluggish economic growth, soft convention calendars, or just face tough comps because they're a little bit overheated in 2023, like Boston. And then looking at values over the next 5 years, our favorite markets, Puerto Rico, Las Vegas, Seattle, and we'll dig in a little deeper on Seattle in a minute. But these are markets that we think really stand out. We also really like Orlando. We think now is the time to be paying much closer attention to San Francisco and Portland as we look at things bottoming out there and sentiment going to improve going forward. Certainly can't get any worse, right? So long-term investors may be rewarded with kicking the tires in those markets. Bottom performers over the next 5 years, Austin convention calendar is really, really tough, with the convention center closing and having a huge impact on that market. Difficult comparison, San Diego and Boston were just a little overheated. We think that'll pull back in the short term. Long term, we're less concerned. And then elevated expense growth, Chicago stands out for that one, especially with a lack of pricing power across that market. Now let's shift gears a little bit and dig into Seattle. So one of our tools that we offer to clients is a web-based application called LARC GIS. It's a data-centric application that is super granular in detail, down to the census block group level. To give you an idea, there are 217,000 census block groups in the US. So instead of looking at 400 MSAs or 700 submarkets, we're literally looking at 217,000 unique geographies. And of those 217,000, about 19,000 of them have hotels within them. So we have super granular detail tied to that many unique geographies across the US. And when we look at Seattle, our general views on Seattle are really positive based on a few different factors. Number one, strong economic growth, right? Economic growth is expected to be in the top third of all the markets we track, which is high for a market this size. You see massive outperformance in 2024 and over the long term. Muted supply growth, just 3.2% of existing inventories under construction, only 463 rooms under construction in the CBD. International inbound recovery. We think this is a great, great story for Seattle. In the 10 years leading up to the pandemic, Seattle had the strongest level of international inbound arrival growth. And then in 2023, we were still 12% below 2019 levels. Year to date, we're 18% up year over year, and basically back to 2019 levels already. And we don't think 2019 is the right baseline anymore because of all that historical growth. We think that trend kind of gets back going, and there's a lot of strong growth. And we estimate that 20% of demand to the market is oriented towards international travel. So as the dollar softens, these trends will further improve. That's a big positive tailwind for that market. And then lastly, the convention center. Boy, the convention center. What was a big headwind for a few years is turning into a really big tailwind. For those of you that don't know Seattle, Seattle in late 2023 opened the Summit Building, which is a $1.9 billion expansion to their convention center. This was a building that was supposed to be open a couple years earlier, but because of the pandemic, things were really, really delayed, and it was very unclear when this was ultimately going to get done. Well, it finally got done. Unfortunately, because of the uncertainty surrounding the opening and the timing of the opening, bookings were a little bit more limited coming out, yet we're still up 37% year over year. And we're hearing great commentary that a lot of the tentatives for 24, 25, and 26 are getting converted now that the added building is open, and we're going to continue to see strong growth in convention bookings for Seattle. We think that's a great story for downtown Seattle. Our forecast model you see here, 99.5% R squared, just like you saw for the other ones that we shared. Here's the drivers of it. Very encouraging metrics for us. And then when you look at our GIS application, where you can drill down to where is RevPAR growth strongest or weakest, this is a heat map of forward 5-year RevPAR growth across the broader Seattle market. And one of the things that you'll see is how granular data is. Dark blue is stronger RevPAR growth than light blue. Downtown Seattle, our GIS application points to a forecast of 9.0% compound annual growth rate of RevPAR from 2023 to 2028 in downtown Seattle. Massive, massive numbers, super positive. Submarkets like Bellevue and Redmond are likely to underperform a little bit. They're a little bit more tied to individual one or two corporate accounts, not quite as strong as downtown, which is a much more diverse economic base, coupled with the convention center, coupled with the attractions of all the international inbound arrivals. So net, we really love the Seattle CBD, and some of this data helps you understand a little bit why. With that, I am going to just highlight a little bit on our forecast for Seattle versus some of the other guys out there. So in 2023, actual results for Seattle was 7.3%. Our forecast was 9.9 going into the year. So this was in December 2022 for 2023. The other guys were 16.9. So we're all really positive, but one of us was a heck of a lot closer than the others. Not saying we're perfect, but we are clearly proving out to be materially more accurate than them. And then in the first quarter, actual results were 8.8%. Our forecast going into the quarter was 11.1. The other guys, 22.8. Again, a heck of a lot closer. We're forecasting about 10% RevPAR growth versus their 12 for the full year. We're willing to bet that our numbers are going to end up being more accurate yet again. Again, this kind of points to another example of how at a market level, we are just materially more accurate than some of the other guys. So if you're actually purchasing forecasts or relying on market forecasts, know what you're buying and what you're relying on. And with that, I will just highlight our service offerings at LARC include 3 core components. We do quarterly market intelligence reports on 62 cities across the US every quarter, everything you want to know about that hotel market. We have our LARC GIS web-based application, which is really unlike anything anyone has ever seen. Every time I demo that application for a prospective client, I would say 90% of the time that contract is signed within a week. People are amazed and ready to use it, dig in, and really leverage a tool that is unlike anything they've ever seen. And then lastly, we do a ton of commissioned forecast work and consulting assignments tied to market forecasts, sub-market forecasts, things that are totally customizable. So if you're interested, feel free to reach out to us on any of those things. And last but not least, if you have anything you want to talk to us about, but don't want to do it on this in this webinar, feel free to shoot us an email at information@larcanalytics.com. And with that, I'm going to turn it over to Katie. And Katie, how are we doing on the Q&A?
We don't have too many today, but
Great.
the first one, I believe this was talking about like when you were discussing the return to office, but it says there's been large year-over-year declines for a full trailing year in Orlando, more dramatic than the overall US. Are there any demand drivers that point to that trend reversing?
Can you read that again for me?
Yeah, there's been large year-over-year declines for a full trailing year in Orlando, more dramatic than the overall US. Are there any demand drivers that point to that trend reversing?
Yeah, I think the big demand driver that's pointing to that trend reversing is a couple of different things, and it depends on when you point to that trend reversing. Right, timing is always an issue. Look, domestic leisure has faced a tremendous amount of headwinds. Right, and Orlando certainly gets its fair share of domestic leisure. We haven't had the foreign inbound leisure like you would like to see across the country. But I think the two things that stand out for Orlando going forward is one, the convention calendar is improving, which is going to be very positive. Group is picking up, which is also very positive for Orlando, which is a heavy group market. And three, you have a tremendous amount of pent up foreign international demand into Orlando. And with the opening of things like Epic Universe next year, that's going to be a game changer to that market. Somebody told me they generally believe that a new theme park like Epic Universe will generate 1 million new room nights of demand to the market. I don't know if that's necessarily 100% accurate, but it's an interesting rule of thumb that I know intelligent people pay close attention to.
When you measure convention center bookings, are you looking at the number of conventions room nights tied to the centers or some other metric?
Definite room nights booked.
What do you think of the upcoming convention center closures in Austin and Dallas? How will that potentially impact competitive Texas and California markets?
So a couple things I'll say. So we think Austin, it's a big issue and a headwind in Austin. And Katie knows this. We just did an Austin CBD forecast for a specific client where they wanted to really dig in deep and understand what the convention center impact is. It's going to be challenging in 25 and 26 in Austin. There is no doubt about it. The convention center has a big impact on that market. On top of that, economic growth and the drivers of overall demand growth. To give you an idea, non-convention center demand in Austin CBD grew at about a 6% CAGR from 2000 to 2020, and from 2020 or 2019, and then from 2019 to 2023, as corporate has changed dramatically with office utilization shifting things, demand growth, non-convention demand growth dropped to 2.6% per year. That's a big change. We think that demand, we think that the non-convention center court demand will continue to improve, but it's a big hole to fill with the loss of the convention center. And while the convention center will be closed from March, or I guess April of 2025. They're hoping to have it open in 2029. We all know that municipal-driven developments don't necessarily operate on schedule, and 2029 could easily turn into 2031. So that is a huge concern for us. Dallas, we have less of a concern because of two things. Number one is Dallas, while the entire thing is being closed, they're rotating how things are being done, and it doesn't. So it's not going to have that same negative impact where it's just outright closed for 5 years and you don't get any demand. Number two with Dallas is it's not as big of a component of demand across the market, so we don't think it's going to have anywhere near that impact. Now, people ask all the time, well, who are the beneficiaries and who are the winners and the losers from a convention booking perspective with Austin and Dallas closing? And I think the obvious answers are other Texas markets like San Antonio and Houston, other regional markets like New Orleans, Oklahoma City, Denver, Phoenix, etc. But the reality is we've known about these closings for a couple of years now. So go take a look at the pace data for each of these markets, and you'll know which ones are benefiting and which ones aren't. Or at least if if they're benefiting and the numbers are still looking bad, then it doesn't matter that much that they're benefiting, right? At the end of the day, we think a lot of this is really built into the pace metrics already, and that's what we focus on.
Will you be sharing the slides, which is yes.
Yes, we will be.
And then same, we provide recording and slide deck. So next one.
The recording will be posted on our website, so you can check it out there. Slide deck will be emailed out. I'll tell you, I tell everybody every quarter that we're going to send it out. Doesn't matter. We get the question over and over again.
Do you provide forecasts by market and submarket, and what is the forecast accuracy?
I think it depends what you're looking at, but we provide forecasts by market on a quarterly basis. We do submarkets on an ad hoc basis, and our GIS application provides forecasts super granular down to the census block group level. So instead of looking at 700 submarkets, like I said, we've got forecasts for over 19,000 unique geographies. You can literally type in your hotel name or your development site, pick a radius around it, say it's a 1 mile radius or a 5-minute drive time zone, whatever you want, and we'll tell you what the RevPAR forecast is going to be for next year and the 5 years after.
We have a handful of hotels in Texas. I briefly saw that a few markets were top performers and others not. In general, we always hear Texas is volatile given the oil industry, but I'm curious if you have any market-specific insights.
Yeah, so we think Houston's an interesting market in the next couple of years, partly driven by that energy industry that's performing pretty well. Dallas and Austin, we just talked about the convention centers. San Antonio is a market that we're not overly bullish on, but we're not overly bearish on either. San Antonio is a bit of a stable, steady Eddie type market, not high growth, low ADR, driven by group, domestic leisure, and military defense spending. And that third one is incredibly stable. So you just don't have a ton of growth in that market, but that's okay. It's a stable market. You just have to be comfortable with that stability as opposed to underlying growth. Obviously, domestic leisure had been pulling back. We think we're now starting to anniversary some of that middle of this year, and that will be less bad going forward. But that's been a challenging market for the last 12 months or so.
NYC, 20% of inventory is out for asylum seekers. Do your projections account for any of the supply coming back as hotel rooms in 2025 and beyond?
In short, it's not 20% of the broader market. It's north of 16,000 rooms on close to 160,000 rooms in the New York City market as defined by STR. So it's more like 10%. But it's a big number nonetheless. No, our numbers do not include that. The reality is our views on New York are kind of interesting in that we actually think fundamentals are okay. The migrant housing dynamic for the hotels. I think the challenge that you encounter with those hotels is that the longer that those hotels are offline for migrant housing, the more they become less hotels and migrant housing or shelters, and the cost to convert them back to a hotel becomes more of a redevelopment cost than minor renovation or repositioning cost. So as a result, they'll go back in the pipeline, and even if you lose a contract or transition back in 25 or 26, it may take 2 years for them to convert back to hotels. So we see less risk from those perspective. That being said, it's possible that that does materialize. So it's something we're watching closely. But New York also has short-term rental dynamics that are fascinating right now, where the headlines are really negative, are really positive for hotels, that all these short-term rentals are offline. The reality is, if you look at the data, that's not entirely the case. And I think that sentiment towards New York today is incredibly positive, where we're really cautious when it comes to labor and what's going on that end with the new union contract coming up in 2026. Net, we think a lot of the good news is priced into New York right now. We're not super negative on fundamentals over the next 5 years, but we're not super positive on valuation continuing to grow, given where sentiment towards the market is today.
Epic Universe brand new amusement park coming to Orlando 2025, and 17 billion investment in Disney parks over the next 10 years. I don't really think that's a question, but
Yeah.
uh,
Well, we talked about Epic Universe earlier when somebody asked about Orlando.
do you ever do you see a more optimistic picture for the Domain area in Austin, which is less reliant on convention business?
Yeah, I think any of the areas that are less reliant on convention will perform better than the CBD over the next few years, certainly 25 and 26. But that being said, there's going to be a big sucking sound coming out of the CBD. There's a lot of inventory there that's going to get priced more aggressively to try to attract demand. And there's going to be a lot of people that say, well, I'd rather stay at the JW or the Fairmont downtown for the same price as the Courtyard in Domain. And as a result, you're going to see less compression, or at least more desire to stay downtown for some of those transient travelers. It'll weigh on things a little bit everywhere. You can't assume that when downtown is going to be off as much as it is, that it's not going to impact the rest of the market. It will, just maybe not as badly.
What are your thoughts on downtown San Francisco's recovery?
I think we're at a point where things are starting to look better. This is the worst year from Moscone perspective. Things are going to get a little bit better there. We're hearing a ton of news surrounding a groundswell across San Francisco, trying to clean things up and get things better. It takes time, and nothing happens overnight. We think that when you look at San Francisco, if your baseline is 2024, San Francisco should look really interesting, because we think that realistically, you're going to see some decent growth over the next few years relative to 2024, 2023. If your baseline is 2019, that's not going to look so good. At the end of the day, we think the pre-pandemic numbers are unlikely to be visited for the foreseeable future across the San Francisco market.
What level of data/information can you provide for tertiary I don't know how to say this word.
Tertiary
Yep,
markets.
not listed in the slides.
Our LARC GIS application has all kinds of data from economic activity, retail sales, office employment, RevPAR, and forecasts for all of these metrics on an annual or 5-year forward basis for every place there's a hotel in the United States. If there's a hotel, we've got the data. Super granular, whether you're looking at Marfa, Texas, or downtown San Francisco. We've got that in the GIS application.
What is your assessment of some of the sputtering in demand for Nashville this year? Do you feel it's tied to increased supply, group softness, or something else?
Oh, I love this question. I get this question a lot. So there is a thesis out there that Nashville, that elevated supply for the last several years is having an impact on Nashville, and it finally has hit the market. We do not believe that is correct at all. Nashville is a great market. This year is driven by two simple things that we talked about throughout this presentation. Number one is domestic leisure demand, and Nashville is a domestic market. There was one international flight out of Nashville. It goes to London on British Airways. Otherwise, this is a domestic market, catering to domestic leisure travelers. And we all talked about how that has been a challenge over the last 12 months and will gradually get better over the next 12 months. That's number one. Number two is the convention calendar is really soft this year. That is not a permanent thing. That's the reality of what we're seeing right now. That will moderate, and the convention calendar doesn't look bad over the next few years. So those two factors are what's driving it. It is not a supply issue. Long term, we are huge believers in Nashville.
Does LARC monitor and track transactions, especially those of major REIT or private equity players that set the trend for the general market?
We do, and so do our partners at LW Hospitality Advisors.
Your
Their
projections had, oh, sorry.
transactions are available in every market intelligence report that we issue for all those markets. And they will be available in our LARC GIS tool shortly. And our partner, Dan Lesser from LW Hospitality Advisors, actually puts out a quarterly email with all the recent transactions that are relevant across the industry.
Your projections had Portland as one of the top future performers. What data points give you this confidence? The city is still suffering from post-pandemic effects plus new supply.
You are correct. The city is still suffering. There is a low baseline. 2023 was pretty soft. Convention calendar is starting to improve. You just saw the city council fully turn over, and economic outlook in terms of growth profile for retail sales, office employment, GMP growth, jobs, you name it, all the core metrics are actually starting to turn and look really good over the next few years versus the past few years. So our point on Portland and San Francisco, for that matter, is things are actually bottoming out in our view across those markets. And now is the time to really pay a little bit more attention to them. That being said, don't underwrite things like they're going back to pre-pandemic levels. Underwrite things that you're going to see good growth from current levels, and you'll be happy.
Are we seeing any indication that increased global temperatures are affecting demand in certain leisure markets?
You know, we're not seeing a ton of it yet, but it's certainly something that we're mindful of. We track a lot of things, especially in our GIS application. We have changing flood zones and sea level rising and falling. Some of those key metrics that we think are really important with some of those coastal markets where it can have a big impact. We have not yet seen those impacts, but we are definitely concerned about, especially what we would call southern ski areas. Southern, snow skiing areas where, the season is getting shorter and shorter every year. But beyond that, we haven't seen a tremendous amount of impact.
And as of right now, this will be the last question, but how long do you think it will take San Francisco to return to its pre-pandemic levels with convention demand down 31% and weak corporate demand?
Well, I think the corporate demand is going to gradually improve. The convention center is going to gradually improve from as bad as they are this year, but we do not foresee it getting back to pre-pandemic levels within our forecast period, which is the next 5 years.
And that's the last one.
All right, everybody. Well, thank you so much for tuning in. I hope you found this helpful. And if we can be helpful in any way, please feel free to reach out to us at information@larcanalytics.com, and we'll try to be helpful and get you whatever you need. Thank you very much, and have a great day.